My name's Adam Gilbert, partner at PwC. I'd like to thank Vice Chair Bowman for putting on this very important conference and inviting me to moderate and pulling together this outstanding panel. Let me introduce them quickly. Daryl Bible to my left, M&T Bank, Alistair Borthwick from B of A, Rahul Nalgokar from BMO, John Stern from US Bank, Mike Verdeshi from Charles Schwab, and our anchor, Sharon Yeshaya from Morgan Stanley. So thank you to all of you for joining us and for this terrific panel. It's fitting that we close the day with perspectives from CFOs. The CFOs play such an important role in the capital process at banks. In fact, they own or manage with their teams the capital calculation, the allocation of capital in the bank, the capital action planning process, the communication with investors about those capital actions, and importantly for this forum, play a leading role in policy discussions. So it's really appropriate that we conclude the day with perspectives from the CFOs. So I'd like to start by asking for your perspectives on why reforms to the capital framework are so important at this time. Does the current framework cause you to make suboptimal or inefficient decisions? Are there competitive issues that are especially problematic because of the framework? For example, have the capital requirements played a role in pushing assets outside of the regulated banking system? We've heard about that, some of that today. So Mike, would you kindly lead us off on this framework setting question?
Yes, thank you, Adam. And again, on behalf of the panel, thank you, Vice Chair Bowman and the broader Federal Reserve. Important set of discussions today centered around ensuring safety and soundness, while at the same time ensuring the banking system can support growth in a range of environments. Taking a step back, so much of what is the capital regime today was born out of the experience in the crisis of 2008. Since then, the capital regime has evolved, but so has capabilities at firms and a broad range of capabilities managing across risk stripes. And that is a really important element to think about, certainly as they connect. Stepping back, yes, this is the right time for that holistic review. And really, we heard much of this today. Three themes I would highlight. Think about that holistic view in terms of where are the best practices that resulted in the capital regime that we have today. Where within the capital regime do we have redundancy and therefore inefficiency? And then lastly, what parts of the capital regime have unintended consequences? And to unpack that a bit, some of those best practices we just heard from the stress testing conversation. Those internal stress tests have been developing over time, and the banking system have gotten much better at them in terms of identifying emerging risks in the face of an evolving macro environment and understanding whether you have the capability to manage those risks in a range of environments. And importantly, tailored to one's business model and tailored to one's business strategy. So I think I continue to emphasize the use of internal stress tests, whether that's a complement, whether that's the primary. It's really important that internal stress tests are utilized. In terms of redundancy and inefficiency, again, we heard about the different elements of the framework, leverage, evolving risk-weighted assets, and then importantly, stressing risk-weighted assets. And do we have more capital through those mechanisms than what's needed? And does that in any way get in the way of providing that capital to the broader economy as needed? Importantly, as well, in the inefficiency, as we see environments unfold like we did in 2023, there were different elements that caused problems of certain banks, and that was the connectivity of liquidity and how that interacted with interest rate risk. It's important that capital is relied on for the solution of all things. It's important as those environments unfold and there are certain vulnerabilities to ensure that The framework entails making sure you have the capabilities to manage those risk stripes and not just rely on capital. And so there, sound balance sheet management ensures that you can identify risk, measure various risks, and ensure you have the capabilities to manage those risks in a range of outcomes. That's capital, that's liquidity, but that's also interest rate risk as well. And then just briefly touching on unintended consequences. There's really two elements here I would highlight. One is how leverage can become a binding constraint in times of stress. And we heard it this morning as well. If the Federal Reserve needs to embark on quantitative easing, that liquidity will come into the system. It will make its way onto the balance sheets of financial institutions in the form of deposits. Taking a deposit from a customer is the most basic financial service that we can provide. Simply taking that deposit and leaving it at the Fed account, that would draw capital. Another aspect is if you're taking in deposits in times of stress, does that increase in liquidity necessitate more liquidity in the form of long-term debt and some of the rules that may be unfolding there as well? And then lastly, sound liquidity management. It's always good to have, it's always essential to have enough liquidity on hand before you hit a stress. But even in periods of stress, it's prudent, sound liquidity management for maybe the Treasury community to build a little more liquidity at that time. But building liquidity, again, would be leverage and therefore tying up that liquidity in the form of capital. So it's important to understand the interactions across those risk stripes. And then lastly, we just touched on this as well, unintended consequences. Has the capital regime become costly? Has it become cumbersome to the point where that credit origination is happening outside of the banking system, outside where it's regulated today? And is that a framework that we want going forward? And will that capital origination really be available through the cycle? So with that, I'll take a pause there and allow other members to make comments too.
Others comment?
Yep. First, I just would like to thank Governor Bowman and all the other Fed officials for putting this on. This is a very unique and I think very helpful meeting that you've gathered together. So I really appreciate that. Just to add on to what Michael said is the framework for developing capital requirements should be transparent and appropriately align capital with risk. When capital requirements for asset classes are significantly greater than the underlying risk, lending migrates from banks to non-banks and can allocate to a more appropriate capital level. We see that today in the mortgage market. If you look at the supervisory test, there are numerous examples over the years where the charge-off rates, the capital charges that we got, were much higher than what our models came up with. You could see that in the most recent stress tests with the new category, MBFIs, where they're basically charging a rate now of 7%. If you really look at what the category, what's in that bucket, there's some high-risk lending in there, and there's some really low-risk lending. You got capital call lines, low risk. You got mortgage warehouse, low risk. But you also have high risk in NAV lending. So it's really important that those loss rates that you put in there are really important. The best example is M&T in 2020 got a super high CRE charge rate, such that it was in double digits, mid-teens, and we basically went on a path now for 5 years where we basically shrunk our CRE portfolio. And it was forced by that stress test because the capital charge was too high. You know, we're now down half of what we were 5 years ago and now starting to grow back. But what you put in here, we respond to and we make decisions off of that. And it's really important that we have the best facts. When we talk about models later on, getting the models right and knowing what the losses are is what's really critical so we don't make poor decisions and have to leave things off our balance sheet. When we look at the Basel III endgame proposal, it should consider putting appropriate risk weights in those categories. Recently, senior regulators suggested and review of some SR letters, the impact of leverage lending guidance is shifting from banks to non-banks. That should be examined. And then finally, the FRB's publication of Reg Q that was in September of 23, where all banks from $5 billion up to the G-SIBs are utilizing credit risk transfers. I think it might be helpful and be transparent how we can basically handle this in the Basel endgame as well as in our stress testing processes, and actually come out with how to handle that stuff. So that's it.
That's great. Thank you. Any others? Sharon, you want to?
I was waiting for my next question.
Your next one.
I might just add
Yeah, John.
really quickly, because I agree with Mike and Daryl on how they allocated that. I think the other thing that, just to tie it together, when we have these decisions on capital, whether it's in the stress test or whether it's in proposals from Basel III endgame, there are risk weight considerations that when we allocate capital to business lines and have to make pricing decisions and things like that, it can really impact how we go to market, how it impacts clients, how it impacts our conversations with clients. That's really meaningful. And so, when Basel III endgame came out as an example, there was a surcharge on mortgage. We had to decide, do we need to upprice all mortgages? And it's already a very competitive market with banks and non-banks alike. So that's just an example. There's others associated with it. But just to tie it together from a client's perspective, we have to answer those questions as well.
That practitioner perspective is so helpful, so thank you very much. So when we were preparing for our panel, many of you felt that any reform should take into consideration the interactions or the interplay of the various components of the capital framework. So Sharon, can you elaborate on this point?
Yes, I'd love to. First of all, thank you for having me. I felt very strongly about this question. First, I'd really break this into two pieces. One is we have leverage, and I think that the Fed and the OCC and the FDIC are doing a great job with the proposal to make leverage more of a backstop rather than a binding constraint. So let's put that aside. We've spent a lot of time talking about the building blocks of CET1 and what it means on Randy's panel, and I'd like to pull some of the points that have been made kind of together. The first question that you opened with is why now? Why is this the right time to be having this conversation? And when you started to really feel and understand the overlaps, in my mind, it came when Basel was introduced. Basel is, as we know, was intended to really relook at the underlying base RWAs that we have. And there are, when I think of the building blocks for your regulatory requirement, you have your base RWAs, then you stress those bases, and then you have buffers on top of them. The base RWAs are the questions that we've begun to face and we think about when we look at Basel, and we say, is this the right base, and should we be changing the underlying base for a regular run rate business? Now, that might be the case. You might be in a situation in which we should change the base. That's a discussion to be had specifically with each of the underlying RWA proposals around Basel. However, when you begin to put that into a stress testing regime that has already existed, some of which was intended to compensate for the fact that you didn't have Basel endgame yet implemented, that's when I think you begin to look at these potential overlaps that weren't addressed in the original NPR. And I think one of the main reasons in my mind why a form like this has become so valuable is that we begin to look at it and try and think more holistically. I often give the analogy of, it feels like, obviously we're based in New York, and it feels like an old New York City apartment that they just keep painting over and over and over again. And you're sort of like, what color was this supposed to be? And so I think that we should strip the paint, and we should take a look and say, what are we trying to achieve? And then build both base and stress, bringing them together. And if you want to put on top of that, then an additional buffer, call it G-SIB. I think that some of the points that Steve made on his last panel when we did the G-SIB buffer, in terms of short-term wholesale funding, in terms of rebasing things for GDP, those are really important to keep it fresh, the same way that you want to keep stress fresh. You don't want stress to be static, because the stresses in and of themselves, as we just heard in the last panel, change. So I'd go back to sort of what are your first principles? Your first principles is to figure out how much capital do we think needs to exist within the system. And once that decision has been made that this is the kind of size of the capital system that we have, and this is how much the banks need to hold, fine. How do we then adjust and kind of give that capital or allocate that capital appropriately to the risks that are being run on a day-to-day business? And that has to also do with the business models that the businesses have and how they've evolved. And I don't think it's about gaming the system. The banks are not we're not trying to bring ourselves down. And so I think that we need to kind of get past the last 20 years and say that there isn't an intention to fail. We are also, we have review and challenges. We're trying to make changes as we actually go through these stress tests in terms of our own institutions. And so then allocating, the question becomes, how do you allocate it appropriately?
Thanks, Sharon. Others want to jump in on this point?
Well, I guess only I should start by thanking Governor Bowman. Thank you. Thank you to the board for inviting all of us. Thank you to the panels before, because I thought they were all terrific in their individual sessions. But each of these individual rules that we all face every day is well-intended. And whether it's SLR or G-SIB, whether it is the stress capital buffer, TLAC, the interest rate, risk management, they're all designed for safety. And if it's only one, if there were only one thing, then some conservative is absolutely natural. One would expect that, hope for that, etc. But actually, this idea of this connection between them really becomes important to us as practitioners, because we're managing all of them. And we're managing not to one stress test, we're managing to all of our stress tests. We're running multiple stress tests by the week, by the quarter, by the month, all the time. So in total, these rules tend to get to be more conservative because they're greater than the sum of the individual rule. That's what we're optimizing. That's the inefficiency. That's the efficiency that you can unlock to pass on to consumers, the US economy, to jobs, to loans, etc. So that's the public policy. That's the good that we're all after. And that's why we're so pleased to see a holistic review that actually takes a look at how those things intersect with one another.
That's great. Thank you. Ro.
Sure. First of all, Vice Chair Bowman, thank you for having this, and to the entire Fed staff here, this has been a great experience. I think just kind of as the panel was discussing, the three things which keep coming back in general here is the capital framework balanced? Is the capital framework holistic? Is the capital framework clear and has clarity? And I think that's where these things keep coming back, is in the balance side being, do we know the financial risk and are we balancing that with the economic growth? On the holistic side, have we, I like your analogy, I'll remember that one. Are we painting the building again and again, or are we actually looking at the root causes and associating the solutions with those root causes rather than a patchwork? And then clarity is very important. I think as practitioners, we'll all, and those of you in the audience would agree, when you have to put this into actions and the models are run, and practically you are deciding whether it's your business model, whether it's your stress testing regime or capital management, practically how do you put that? And clarity not just in terms of have you understood it, but also how will you explain it? Explain it to your investor, explain it to your board. So I think going back, those are the three things which keep coming back is it balanced? Is it holistic, that there are no downstream implications, unintended consequences, and the third being clarity?
Terrific. Thank you, Raul, for that. So I want to get into some of the specific components of the framework. But before we do, John, Daryl, and Raul, as regional banks and an FBO, respectively, tailoring is a critical determinant of how you manage capital. So as Governor Bowman and the other agency principals proceed with their reform efforts, what should they be thinking about or specifically addressing with respect to tailoring? John, you want to start us off?
I can start us off. You're right. First of all, the tailoring is a very important part of how we think about capital. I mean, obviously it impacts us in terms of how we compete with other banks. It obviously influences how we price certain sorts of asset classes and things of that variety. Specifically, when we're looking at capital allocation for different business lines and these sorts of things, it's very impactful in how we think about it. So, obviously, you have an opportunity here to take a look at things. I think, and the way I think about it is there's really three things principles I would think about as going through it. The first is really about simplicity. You know, Jerome talked about it and others in terms of we've had the last 15 years, we've had multiple capital regulations on top of each other. They are competing priorities that we need to address and think about as we're going through it. So the ability to simplify is obviously very important. It allows for the capital planning components to be much more streamlined from our standpoint, and it allows for maximized pricing for when we go to market. The second is really about indexing and how do we index appropriately from a threshold perspective. This is really something we've been focused on for some time. Any bank that is at 99 billion or 249 or 699 knows that there's some impact when things, from $1 to the next, you'll be in a different type of regime. And so the indexing of that is, at this point, those index thresholds are static. And obviously we have a very dynamic macroeconomic environment that we are in. And so therefore, from a standpoint of having that dynamic ability, we want to make sure that the index is adjusted for something like GDP or inflation or something. Otherwise, you will pull forward. Just think about 10 years from now, you're going to pull forward a number of different banks into different regimes that may or may not be appropriate despite that sort of indexing. And that kind of gets to my last point, which is really about the cliff effect as we go forward. As you go into these sorts of things, there is that bank at 99 that is going to go to 100 the next day, and suddenly everything changes. And I think there can be an opportunity to think about smoothing, or how do we think about pre-positioning some of those regulatory activities before approaching that threshold, and then what are the things that can take time and be adjusted over time as well. Post-adjustment, so it's not the cliff effect. At the end of the day, we have a number of diverse banks, and so that's what the beauty of tailoring can do, is can adjust to all that, but those are important things that I would think about.
Yeah, I'll just add on to that, John. First, for us, and I think for many of the medium-sized and smaller banks, I think it's important tailoring actually happens and it's real, so it helps us serve our customers and communities as we serve our clients. When you look at tailoring, it's important that we align the scope with the complexity of the regulation and the risk that we're trying to solve for. Supporting thresholds for capital, liquidity requirements, and like John said, indexing for inflation, I think are really important. Consider utilizing more, maybe a macro factor, multi-factor model, elements that are a way to determine thresholds rather than just total assets. I think one of the important points is that future regulations should continue tailoring approach. For an example, when Basel endgame was proposed, it had market risk for the smaller banks. There's really none of the smaller banks that really had any risk in that area. So we need to be really aware of what services and products they have before you try to put rules in place that we have to do that don't make a lot of sense. And it's also important that tailoring applies to supervision. And when we say supervision, we don't want to be treated as one of the larger banks, such that we want to follow the rules that are really important, like credit risk, interest rate risk, liquidity risk, operational, cyber. Those are the real key risks that you really need to do to make sure you run a really sound company. But other things around supervision, I think, are more for the larger guys than for more medium and smaller banks.
Yeah, I think for the FBO, we are more of a super regional in the US, so I guess they've already covered the things on my mind, so I won't repeat.
Okay. Let's get into some of the specific components of the framework. So, Alistair, we now have a proposal on the ESLR, TLAC, and long-term debt, and a very important question put forward on the treatment of treasuries. So what are your thoughts on the proposal?
Well, I thought the panel did a really nice job of talking about SLR and ESLR. And, again, this is one rule. It's not the only rule. It was intended as a backstop. And then there's a lot of other things that we all have to operate under. capital, liquidity, interest rate risk, et cetera. So what was interesting about the pandemic and the lesson that came out of that for all of us was that ESLR became too binding. It became the binding constraint. And so we feel like recalibration makes sense. We're supportive of that. And it's going to help banks in 3 or 4 ways. First, it provides ample capacity to absorb liquidity in future stress. This was Tiffany's point on the panel when she said shock absorber for liquidity. That's what she's talking about. Do you want America's banks being able to take liquidity as the government is pumping in stimulus to fight a healthcare problem? Okay, so that's going to help with that. Second thing, it will help support functioning of the U.S. Treasury markets, and a couple of the panelists talked about how important that is. It's a bedrock principle for our economy, for capitalism, for America's competitiveness. It's going to help. So that's number 2. And number 3, it's in line with banks all around the world. It's now the U.S. getting in line with other jurisdictions. So we're not SLR constrained right now. That's different. There are different banks that are SLR constrained, but it gives more flexibility, more capacity, and I think it was Ben who talked about that in the panel earlier, just how much it gives banks freedom, flexibility to do things. So I thought that was helpful as well. The narrow exclusion of U.S. Treasuries makes sense. It's definitely helpful. Everyone can understand intuitively why we would do that. It will give us a little more capacity, but of the two, obviously, recalibration is a lot more helpful.
So, Darrell, Mike, and Raul, does the question on treasuries trigger anything for you with respect to, the treasury question relates to broker-dealers, and does that trigger any considerations from where you sit?
I mean, for M&T and for the vast majority of smaller banks, it's really not an issue that really has any impact on us. The only thing I would say is if you're going to adjust the SLR ratio, consider adjusting maybe the Tier 1 leverage ratio as well, because we would be impacted from that perspective, as well as just trying to be consistent from a leverage perspective.
I think similar to what Darrell mentioned, not a binding constraint, but if we are looking at this, I think it makes more sense not to just look at the treasuries, but as this whole concept started as leverage started as a binding constraint, as a backstop, which became a binding constraint, you want to also look at the unintended consequences of all the items on treasury, whether it's cash reserves, whether it's the treasury repos, because then you are looking at this holistically end-to-end, using your terminology. If banks are the shock absorbers for the market liquidity, what else are the products out there which you look at it end-to-end?
Mike?
Yes, and I would say on the Tier 1 leverage, certainly should be looked at as well. And again, it's that risk-off environment where liquidity can come into banks, and having the ability to either leave that at the central bank account, tying up capital would seem unnecessary, certainly for reserves. I think treasuries, it goes back to that broader question, what is going to inform how you hold capital against treasuries? Is it anything at all? Is it leverage? Or is it stressing those treasuries into market values and holding capital against that? So I think the treasury question is important to look at broadly.
Great. So, Alistair, we had a discussion earlier about the G-SIB surcharge. So what's problematic about it, and how should it be fixed in terms of design and calibration from your perspective?
So I think, funnily enough, this is going to echo some of John's comments just a moment ago, and it will also echo the panel that we heard earlier. We have two big concerns with the G-SIB. The first one is international jurisdictions use method 1 only. So we all know that. The US uses method 1 and method 2, greater of. So when people talk about gold plating in the US, that's one of the things they're talking about. It's just a higher standard here in the United States. For most of the big banks, method 2, the surcharge is 100 to 200 basis points higher than method 1. So that's what you're talking about when you talk about quantifying gold plating on this one narrow point. The second issue is that method 2 uses fixed coefficients that haven't been updated in a decade. So that's problematic for us because during the course of the past decade, a lot has changed. GDP is up 60%. The S&P is 3 times larger. The tradable float of securities is much larger. The US bond market is much larger. and likely to get larger from here. So there's a lot going on. Banks are larger too, but if this is meant as an indicator of systemic importance, banks may not be any bigger as a percent of the system, actually. So the two potential solutions that the panel discussed, and I think they're both entirely valid and the ones we should consider, are first, should we eliminate method 2? That may be something to do in the context of Basel III finalization, look like the other jurisdictions around the world, remove the gold plating, and level the competitive playing field for US banks. That's one possibility. And the second is we can recalibrate method 2 for economic and financial growth. Nominal, most likely, so that you've got something that's indexed and where you're really talking about real growth, systemic growth. Are you systemically more important today than you were 10 years ago? And then you just kind of need something that's annually thereafter. The points on window dressing or cliff vesting, I mean, I think there's good ideas around that of averaging over time. Wouldn't support daily, but whatever it may be over some period of time, and narrower variations in the cliffs. Those, I think, are easily solved also.
Terrific, thanks. Let's pick up on the stress testing from the previous panel. There's a foundational question here about whether and how the stress capital buffer should be fully embedded into Pillar 1 as part of the capital stack. So my question to you is, should it be? Should there be 2 capital stacks, for example, one that includes the SCB and one that doesn't? Should the stress test be a supervisory exercise only and not formally incorporated into the capital requirements? How do you see the trade-offs? So, John, you'd like to start us off on this one, and then Sharon maybe pick up from there too.
Sure. Yeah, I can start us off. From a stress or from a capital framework perspective today, as a Category 3 bank, we are in effect the single stack firm. So we have the 4.5% minimum, and then on top is the stress capital buffer. From a simplicity standpoint, that seems to be an effective way for us, and I think that can be, whether people want to use that abroad, I think it would be helpful. I think the simplicity of these sorts of things always can be very good from, I think from a regulatory standpoint, it allows focus as well as the tools that regulators can use from a supervisory standpoint around that can be very helpful. I think if we were going to do that and have it in Pillar 1, which I would agree with, then I think you have to have tenets along with that. One would be the transparency of it. We've talked, I think, a lot about the transparency in the models and what that all looks like. I think that would be very helpful. That allows for that comparability, allows for the transparency from a regulatory as well as from a bank standpoint, and understanding how to communicate what the capital requirements are. And I think from a holistic calibration standpoint, that's the other component, is that if you have a single stack format, then making sure that the stress capital buffer, at the end of the day, it's calibrated in a way that, where we aren't 4 layers of conservatism on top of something. So I think there has to be some adjustment as relates to that. So, at the end of the day, I think about, simple, I think of effective, and I think of transparency. I think the simplicity from a single stack allows banks to capital plan better for their clients' needs. I think from a transparency standpoint, that allows investor comparability and things of that variety. And I think from an effectiveness standpoint, regulators do have tools around that from a supervisory, et cetera, to make it work. So that's kind of how we think about it.
Sharon.
Sure.
I know you have
If I could add to that, we talked a lot. We wrote a public comment letter, obviously, to Basel, and we talked about potentially introducing 2 stacks and thinking about Basel in a separate stack, mainly because really there was a question about overlap within the SCB if you did not actually solve for the underlying issues within CCAR. So putting that aside and saying, okay, there are some benefits to looking at a 2-stack approach. Now let's think about if that is not what we want to do and we want to embed Basel into a single stack approach. How do we do that, and can we do it within a Pillar 1 framework? I will echo some of the comments made by most of the practitioners, which is I prefer a Pillar 1 approach versus a Pillar 2 approach. And I prefer that for many reasons, particularly the fact that I think a Pillar 2 approach does it can create a lot of questions around who your supervisor is, what the supervisory guidance an individual bank may get, and where there might be certain biases that come out from a supervisory perspective. So I do think a Pillar 1 approach is better from a practitioner point of view, but also from an investor point of view, particularly within the United States. So that's kind of step one. Now, if we're going to keep going with what is the benefit of Pillar 1, is I agree, there's better capital planning, particularly with an SCB. And why do I say that is, I think that what Randy Quarles did very, very well was moving us to a place where we had an ability to begin to plan, right? We had more planning capabilities than we had historically. Maybe we still have some planning challenges because the results in some of the CCAR tests do have volatility, but at least we're in a better position there. The other point is that we actually have a framework that we already know that we're working in, right? We have a framework where CCAR works. We have a framework that we understand, the RWAs, et cetera. So those are all the benefits that I see with a Pillar 1 approach and one stack approach associated with putting the SCB in it. Now, there are some shortcomings that I think one needs to work through, and I'll break those down sort of into three components. The first that I would note is that your test is only as good as the underlying test itself, right? So yes, a stress test is a great idea, but there is a lot of model dependency, which was discussed on the last panel. And the deviations between the DFAST and the stress test results that the Fed has actually given most of the banks is growing in certain places. And there's a growth that is not very well understood that I think would be helpful and hopefully will be addressed when we have model transparency. But it goes back to a question that I asked Till on the panel, which is, there are changes within industry dynamics. I think that there are industry-level models that don't account for the different business mixes that different banks have, and I find that to be a shortcoming with some of the models that when we think about the overall papers from the CCAR exam that I think need to be looked at. The second point that I would make is that if we do begin to apply Basel into base versus stress, is we have to understand what's the overlap. And I note that within the concept, I think Shira mentioned it, within FRTB and where is GMS, and then also with ops risk, right? Is ops risk in the CCAR exam was intended to solve the question that you didn't even have an ops risk calculation. Well, if you're also putting it into base and you have ops risk in base, does it need to be stressed at the same level? So I think that those are some of the questions one needs to grapple with. And the final point that I would mention on the SCB in general is we talked a lot about, and Morgan Stanley's commented as well, on the dividend add-on. The dividend add-on is just another place where you could say that there's overlap. The ERI test was intended by Basel to make sure that you'd be in a position where you can sufficiently pay out your dividends. The US-based system created, an additional dividend add-on that I find to be unnecessary and is specific to the United States without taking into consideration the usabilities that you might have already from the ERI test.
Thank you for all that. Mike, how else should the stress test regime be improved? And feel free to comment on the transparency and volatility, which came up in the last panel as well.
Well, I think as we've been discussing today, there's a focus on models and the model documentation. And the models, of course, are important tools, but they are backward-looking. And I think that set of efforts needs to be balanced with really understanding the range of environments one can operate in and what are the capabilities and tools you need to manage through that environment and ensuring that you can operate in that environment and maybe mitigate some of that risk before that environment unfolds. So I think the focus has been perhaps too backward-looking on the models, on the documentation of the models, including models that you may have not used. So I think there needs to be a balance with the practical application of capabilities for that environment.
Daryl, I know you have comments too. Thanks, Mike.
Yeah, I just want to bring up the point that John McDonald brought up in the last session. There are other constituencies besides banks and regulators that use these stress tests. The investors, both fixed income and equity, but also rating agencies. And this is the one test publicly that everybody is judged against, and they can kind of see how the performance is. And that's a real critical process in the system and how they incorporate it as well. So it's used by others than just the Fed in making decisions from that perspective. You know, as far as models go, I would say getting the models right is really important. Transparency is a start from that perspective. But you know, banks need to better understand how their models are built so we understand the risks, so we can incorporate them into our risk management. And we really need to, I believe, that both us and the Fed really work with each of our models together so we can share best practices and basically how to model our portfolios. I think that would be really an improvement. And after the results are done, maybe have a process in place where we can calibrate or adjust for maybe next year as well, as we can kind of get better. I'm in the mindset we're always trying to get better, always trying to improve, and just putting processes in place like that I think would be helpful.
Raul?
Yeah, I think on the stress test regime, in the most recent cycle, the data being shared, I welcome in that action. Individual banks were shared. At least we are consuming. There are more questions, but at least it's a good step forward in terms of how that transparency process has started. I think going back to some of the questions is the three things which kind of in the stress test regime we look at. One is the model itself. How are they calibrated? Are they calibrated to individual banks' nuances in terms of, or are the, as Sharon mentioned, the industry averages being put in? The second thing also is what are the scenario assumptions? And I think that's another area to look at. And then the third thing is what is your starting point financial and business model? 23 was a challenging year for banking in general. 24 was different. Clearly that would have an impact on PPNR modeling as things look forward. So I think those are some of the observations.
Great. Let's turn to the Basel endgame. So how should it be fixed in the United States? Sharon, you want to lead us off on that one?
It's a passion topic for me. I think that when you look at Basel, there were two things that I think weren't necessarily taken into account. One was what was already existing within the U.S. framework, so where are there overlaps, as I've mentioned. But two, there were questions on how the underlying financial system, or I think underappreciations is probably a better word, of how the U.S. system worked versus systems abroad. And I'll explain what I mean by that. The first is, I really think that there were two fundamental issues that I would speak a lot to policymakers about. One was operational risk, and one was on the market risk side. So if you first look on the operational risk, Basel itself said that it had issues with its service components and the way that it was measuring ops risk. Despite the fact that Basel noted that there were shortcomings, the U.S. implemented or suggested to implement the operational risk exactly as Basel stated it, really looking at a revenue line item, which is not, I don't think, is appropriate for many reasons. But then beyond that, when you actually went to the underlying pieces, it didn't give credit for certain less operationally intensive businesses like wealth and investment management. I do know that the Fed, obviously, in its most recent speeches discussing potential reproposal, underscored and understood those issues. But it was, I think, again, as I used the word, an underappreciation of the fact that there was, where the service revenues were coming from, and that there is a lot of historical evidence that those businesses do not come with the same operational risk that you might have in other businesses. Then as it relates from a market risk perspective, particularly FRTB, and I'll echo a lot of what Shira said in her commentary, is that the U.S. is one of the deepest, most liquid markets in the world. Tiffany said that as well. And when you look at the depth of that market and the dependence on the capital market system itself, you have middle market issuers, for example, and this is just one example, who are highly dependent on our capital market system. Now, Despite that, FRTB, for example, would look at somebody who has less observable data points, even if it has the same credit rating as a large institution, and would penalize it. We would charge them higher prices, and you're making real economic decisions to Main Street. You're making choices without really understanding how our system, our fundamental system works. That's just one example, and there were many when we were looking at FRTB where I think someone needed to take a step back and say, how does this impact the real economy, and how does it impact the U.S. economy and the way that the U.S. economy has been built and the capital market system has been built. Separately, from an FRTB perspective, as I said on the onset when I talked about overlap, parts of the GMS were really do have an overlap between base and stress, and that overlap was not taken into account when you actually looked at the market risk. It goes to the final point that I'll just make, which was asked by Randy on the last panel in terms of the cost. There are some benefits of, an IMA approach when you looked at FRTB, but they're very expensive, and it's a very expensive process to run. So much so that many institutions would just choose to use a standardized approach. So I think there has to be a weighting between what are you trying to achieve and what's the actual cost from the bank, and then, like I said, continue to look at the various overlaps.
Rahul, you part of a bank that manages the regime in another country as well as here. What are your concerns about reform, the Basel endgame in the United States?
Sure. Our bank in the U.S. is very much like a super regional, similar to John and Daryl here. So just in terms of our business model, our risk profile, and also the footprint. So not much different than what they would also have. I would reiterate the same things as the capital framework. Is it balanced to address the risk and the economic growth? Is it holistic and avoiding unintended consequences? And I go back to clear and transparent. So not very different than what the regionals are seeing.
Yeah, just briefly, I would preserve tailoring, I would avoid excess complexity, and consider interaction stress tests with other roles. As far as what we liked in the prior proposal, I keep AOCI in the capital calculation, and I would also look at the low LTV adjustments that were made from that perspective. I think it's important in the reproposal, the overlapping of capital, including stress test operations that was talked earlier, I think are the important points.
Alistair, anything?
Well, I'll just reinforce what Sharon said and what Shira said earlier. This overlap between the regime in the United States with stress capital buffer, there's already operational risk shock in there. There's already global market shock in there. The Basel III endgame addresses where that doesn't exist in the rest of the world. That's good. It doesn't need to happen twice, though, in the US. So we just got to think about that. I know that's not easy to solve, but that duplication, that overlap is really important for us. And then, Sharon used that example of you need to have a listing in order to get an investment grade RWA weighting. That's another example of, I'll call it US gold plating. I'm not really sure we need that. The way we would look at a company is whether it's listed or not, it's probably got the same credit risk, all things equal. So that's the sort of thing that has a real Main Street impact, and we'd want to go through those sorts of things.
Great. So we've got about 5 minutes left. Last question for the panel, a real practitioner's perspective here. So we've talked about a supervisory pivot to focus more on core financial risks. So what are the implications for you as CFOs of such a pivot, especially considering all that's been talked about today? What might it mean for your staffing, data, operations, technology? Daryl, can you lead us off?
Yeah, so I think banks' risk management is really focused on the key risks that I talked about: credit risk, interest rate risk, liquidity, operational, and cyber. So you start with that. As far as processes and operations, if we know that we have to do, for example, more stress scenarios, we will set up more processes, we will put in more operations, we'll get more automation. We may not get it there the first year, but we're always trying to optimize and always get as efficient as possible. I mean, the less handoffs that we have and the more automation that we go through, we will build out. So the first couple of years could be painful, but I think over time, if the requirements or increased, we can adjust to that.
Other comments? Alistair?
Well, I mean, I just think when it comes to core financial risks, we obviously welcome that idea. It's good to remove some of the, I'm going to call them the non-rule rules. It's so much easier for us as practitioners when there's a law or a reg or a rule. It's easier, it's more durable, it's less subject to interpretation. So it's much easier for us to scale around that. You know, what happens as a result? Less burden on our resources, more focus on key risks, and our people can spend a lot more time taking care of clients and their needs and driving growth in the economy.
Mike, any other comments on this?
Yeah, I would just add that, again, we too would welcome reforms in this space, and I think this does allow for greater tailoring of focusing on the risks that are key for your financial institution based on your business model, based on the clients you serve. So we would certainly welcome reforms in that area as well.
Great. John, anything last? You're good?
Those are great comments. I don't have anything more.
Terrific. Okay, well, there you have it, the CFO's perspectives. Vice Chair Bowman, thank you so much again on behalf of all of us for setting up this terrific conference. We really appreciate it. Thanks to the other panelists. Thank you.
Well, I can't believe it, but we've finally concluded our last panel. I just want to thank so many people for being a part of today and for helping us put this together on, I know we've said it over and over again, but the first of its kind conference where we could bring industry, academics, stakeholders together to hear from each other about how we should be thinking about looking at the capital framework and seeing where we have some opportunities to make adjustments. I want to thank Chair Powell and Secretary Besant for being our speaker last night at the dinner. I want to thank all of our board members. I think nearly every one of them came at some point of today. I want to thank our Fed staff, especially our AV and our operations teams, our catering and service teams. They kept us fed and watered all day today. And I want to thank especially my team, who always exceeds my expectations, and now they've exceeded all of yours, I think, as well. So they're not interested in other jobs, let me just tell you that right now. But I want to thank especially Alex Wells, I want to thank Amal, and I want to thank Francisco and Randy, and so many of my other advisors as well, but they were really integral in putting all of this together in such a short time frame. I want to thank all of you as our panelists. We'll be calling on you, I know, as we're working on developing some of these ideas and thinking more deeply about some of the thoughts that you all have shared with us today. Let's see, I want to also thank, I didn't mention that we had several of our Reserve Bank presidents here today. So that was really exciting as well. And we're doing this during blackout, which is really a taboo thing to do. So in particular, I want to thank Chair Powell for giving us the opportunity to do this at a time where usually we're locked down and not talking about very much of anything. But thanks everyone for being here. I look forward to your feedback and seeing how we can think about doing this more in the future. Thanks everyone.